Yes, so welcome everybody to your next session of Audit and Assurance. I hope you remember. I hope you revised what did we do in the last session and then you came to this class as I told you to. What did we do in the last class? In the last class, we had completed chapter number 5, right? The leftover of chapter number 5, we had completed that. And we moved on to chapter number 6 also. In chapter number 6, what did we see? In chapter number 6, which is about planning, which is what? Which is about audit planning. What did we see? We saw that there are 3 steps in audit planning. What are the 3 steps? Preliminary engagement activities. Preliminary engagement activities, that is, issues that you consider before accepting an engagement, which we already saw in ethics and acceptance chapter. So preliminary acceptance, preliminary engagement activities, developing an audit strategy, developing an audit plan. We saw what is developing an audit strategy. We saw what is developing an audit plan. I gave you a simple example of imagine that you are going on a vacation. Then everything that you do, everything that you decide as to what is the purpose of your trip, what is the scope of your trip, what human resources or with whom are you going to go, what financial resources or what will be the budget, what is the time that you're going to put, the duration. So all of this you decide for audit also, right? That is deciding the strategy of the audit. Whereas the plan, audit plan is what? Audit plan is filling up the operational details, right? As to what is going to be the nature, timing, and extent of your audit procedures, which is what is going to be the nature, timing, and extent of your risk assessment procedures that you decide in audit plan. Okay, then we saw what is interim audit, what is final audit. What was interim audit? Does anybody remember? Does anybody remember what was interim audit? An interim audit is different from internal audit. Don't get confused between the two. Your interim audit is different from final audit. Don't get confused between the two. Does anybody remember what is interim audit? What's the basic point that differentiates interim audit with final audit? Nobody. Nobody remembers. That means nobody is listening. That means you're just switching on the class just for the sake of it. That, okay, the college has asked us to come online, watch an online class. Anyways, online class we are watching from home. So we can just switch on the class and we don't have to do anything. We can just sit in the class, not even sit in the class, just switch on the class and so Shashanka has given me one answer. So Shashanka is saying performed before the year end. Very good. Sonika also is saying the same thing. Apeksha is saying audit report is not prepared for the interim audit, but it is prepared in case of final audit. Very good. So what was interim audit? Interim audit is nothing but my entire audit, I'm just basically splitting up into 2 different timelines. It's the same audit. It is just being split up between 2 different timelines. Rather than doing the entire audit after the year end, I'm doing some portion of the audit already before the year end. Rather than generally you do your audit after the year end, right? When you get your financial statements. So rather than doing the audit, the entire audit after the year end, you're doing a certain part of the audit before the year end itself. That's interim audit, right? There is going to be one single audit report that is going to be issued. That is going to be issued after your final audit, right? There will be no separate reports for interim and final audit. Okay, all right. Then what did we see? Let me share my screen. Let me share my screen. 1 second. Yes. We saw audit strategy. What is audit plan? We saw interim audit, final audit. We saw frauds and errors. What do you mean by fraud? What do you mean by error? What is auditor's responsibility and director's responsibility with respect to fraud? We saw fraud risk assessment procedures. What are the procedures that you apply as an auditor in order to assess the kind of fraud, the risk of fraud involved with respect to one particular client. We saw laws and regulations as to every entity has to comply with the laws and regulations which apply to them, right? So you as an auditor, you're checking whether those compliances have happened or not. Then we saw quality control. Under quality control, what did we say? We said quality control involves three things: direction, supervision, and review, right? There's direction involved, there's supervision involved, and there's review involved. Okay. Now we are moving to the next topic, to the last topic, in fact, of this particular chapter, documentation. We're moving to the last topic, which is documentation. What do you mean by documentation? Now, the auditor, whatever work he's doing, the work that he's doing, the things that he's collecting, he has to document them in the form of working papers. Because if he does not document, what will be the proof that he has done this particular thing? For example, let's say the auditor is checking the sales which is recorded in the books of accounts with the sale invoices. The sale which has been recorded in the books of accounts, what is the auditor doing? He's checking that sales with the sales invoices. He's checking what are the sales invoices, what are the different sales invoices, and he's checking whether it has been correctly accounted for in the books of accounts or not. Because if there's a difference, or if there's an invoice which is not recorded, then there's a misstatement. Then there's a misstatement, right? So he's checking that. Now, when he's checking that, afterwards, let's say he has checked. What is the proof that he has checked? What is the proof he has that he has done this particular exercise, that he has done this audit procedure? The proof is going to be the copies of sales invoices, right? And the list, the breakup of the sales amount. Because in the P&L, you will have total sales, right? Sales for the entire year. But you need what? You need a breakup of that sales amount, right? You need transaction-wise breakup of that sales amount. So that breakup list, that list of breakup, that transactional breakup, which you've checked with sales invoices. So copy of sales invoices. So that breakup, that copy of breakup and the copy of invoices is what? These are working papers. The auditor will tick. In the invoice, he will tick near the amount, and in the breakup again, he will tick near the amount to show that the amounts are matching. To show that the amounts are matching, he will tick in both the places whatever amounts he's checking, because as we told, he cannot check 100% of transactions. So whatever transactions he's checking, he will put a tick on the invoice and on the breakup of the sales. So these copy of sales invoices, this copy of the sales breakup will be working papers for him. He will have to document them properly. He will have to put them in a file. He has to prepare audit files, and he has to put these things in the audit file, right? Okay. Read documentation. Documentation means the material or working papers. Remember, what is documentation? They are working papers, either prepared by the auditor. That working paper can be prepared by the auditor or obtained and retained by the auditor. Either the auditor himself is preparing it or he's obtaining it from somebody else. Correct? For example, let's say the auditor is recalculating the depreciation. The depreciation that the company has already calculated, what is the auditor doing? He's recalculating that depreciation. He's again calculating, he's doing a working on his own to see whether that amount matches with the amount of the client or not. So that recalculation that he's doing, that is what? That is nothing but a working paper which is prepared by him. Correct? Whereas that sales invoices, that sales breakup which was there, what is that? That is a working paper which is obtained by him from others. Correct? Okay. So it can either be prepared or obtained by him. Next, by the auditor in connection with performance of audit. Such material may be in the form of electronic media or paper. It can either be in the form of electronic media or paper. What do you mean by electronic media? The working papers can also be in the soft form, in the electronic form, in the e-form, like PDFs or Excel sheets or your Word files. The working papers can be in the form of PDFs, Excel sheets, and Word files, right? It is not necessary that you have to have your working papers only in hard copy form. No, you can have it in e-form also. Great. The working papers must be sufficiently complete and detailed. This is, of course, it should be complete and it should be detailed. In particular, the working papers should record the auditor's reasoning on all significant matters which require the exercise of judgment and the auditor's conclusion thereon. So the working papers should record the reasoning for all significant matters and the conclusions that the auditor is drawing. Basic point. Next, go to the next point. Working papers should be split up into two different files. There'll be two different files, two types of files. There will be one permanent file. There will be a current file. There will be one permanent file and there will be one current file. What is a permanent file? Permanent file is the file which will contain the documents which are going to remain the same for many years. This year, the next year, and the next year, the document is going to remain the same. So that you will put in permanent file so that you don't have to get that document again and again every year. Correct? So you will put that in what? In the permanent file. For example, the land deed. Let's say the company had purchased the land. So for the proof that the company has purchased the land, there's a land deed, right? You can get what? You can get land deed from the company. So that land deed, that is going to remain the same for many years, right? Till the company is holding that land, till many years, till the company is holding that land deed is not going to change. So where can you put that? You can put that land deed in the permanent file. You can put that land deed in the permanent file rather than putting it in the current file, right? And what else will you put in permanent file? Let's say loan agreement. A loan agreement, let's say it's a 10 years loan agreement. If it's a 10 years loan agreement, that loan agreement is going to remain same, right? That loan agreement is going to remain same for 10 years. So rather than putting that in your current file, you can put it in permanent file, because the same document then you can refer in the next year's audit also. In the next year's audit also, that's permanent file. What will you put in current file? The sales invoices that we were discussing. Those sales invoices that you've collected, that sales invoices and the sales breakup, that is what? That is related specifically to this year only. That you put in current file. That you put in current file. Whatever is specifically related to this year, like the bank statement of this year, the sales invoices of this year. The bank statement of this year will go to current file. The sales invoices of this year will go to current file, right? So matters of this year's interest will go to current file. Simple. Okay. Next, what is going to be the contents of the working papers? What are you going to include in the working paper that you prepare? For example, I told you, right? You are, let's say, preparing or you're recomputing the depreciation amount. The depreciation amount the client has calculated. The company has calculated the amount of depreciation. You are recalculating it. You're again calculating that depreciation to see whether the amount matches with the amount which is being shown by the client, right? Now, when you're recalculating that depreciation, you're preparing that working paper. What all should you include in that working paper? Let's see. Include the reporting date. What is reporting date? The balance sheet date. Basically, what is the period for which you're auditing? What is the period for which you're auditing? So include that. Include the file reference. In which file is this particular working paper of depreciation? Where is it going? In which file is it going? So include file reference. Let's say it's going in current file number 5. So write that on the working paper, write the file reference as to in which file are you going to put this particular working paper. So file reference. Next, name of the preparer, right? Who's preparing it? Date, when are you preparing it? Name of the reviewer and date of his review. Who's going to review this working paper? Also, every work which is being done, it is reviewed by a senior person. So if the audit staff is making this particular working paper, it will be reviewed by the assistant manager. If assistant manager is making this working paper, it will be reviewed by a manager. What do you mean by reviewed? What do you mean by review? You tell me. What's the meaning of review? What do you mean by review? What's the meaning of review? Name of the reviewer. What is the reviewer doing? What is review? Review is nothing but checking. Checking that working paper as to whether it has been correctly done or not, whether it matches as per the auditing standards or not, whether it is containing details or not, or is it incomplete? Is it complete and is it detailed? Is it containing the reasoning? The reviewer will check all of that. The reviewer is going to check all of that as to whether that working paper is correct or not, right? So name of the reviewer and the date. Subject of the working paper, you will write the heading of the working paper. The heading of our working paper is going to be calculation of depreciation. Write the objective. What is the objective of doing this? What's the purpose of doing this? Work performed, do the work, calculate the depreciation, and then draw a conclusion. Then you will come up to the result or towards the conclusion. These are some of the contents that you will include in the working paper, right? Remember, there is a preparer, there's a reviewer, there's a person who's checking this, and both of their names and both of their the dates on which they're performing this work will be performed on the working paper. Great. Now, let's move forward. What are some benefits of documentation? What are some benefits? Read. It provides evidence of the auditor's basis of conclusion, right? It's providing evidence for the auditor's conclusion, for what is the base for the auditor's conclusion, what is the basis on which he has drawn that conclusion. So it is providing evidence of the auditor's basis of conclusion. Next, it is providing evidence that audit was performed as per international standards in auditing. What is the proof that you are following auditing standards while doing the audit? The proof is nothing but the working papers. The working papers can be the proof that yes, you're doing the audit as per what? That you're doing the audit as per the auditing standard, as per international standards on auditing. Okay, great. Next, assist with direction, supervision, and review. Where had we seen direction, supervision, and review? We had seen DSR in quality control. In order to make sure that the quality is maintained of audit work, what do? The engagement partner is responsible for direction, supervision, and review. Yesterday, we saw that in this chapter only, the last topic of this chapter. Correct? So in direction, supervision, and review, it is helping you. Okay. Next, enables the engagement team to be accountable for its work. It is enabling the engagement team to be accountable. You can hold people responsible that this person has prepared this particular working paper, so he's responsible for that. He's accountable for that. And lastly, it retains a record of matters of continuing significance for future audits. The things that you're recording in permanent file, that is going to help you in the future audits, right? It is retaining the documents that can be used for future audits. Okay. Next, the basics. See, this is clear. This is very simple. Read. Why is documentation required? It is required as an evidence of work done. It's the proof that you've done that audit work. It is required as a part of quality control, as a part of direction, supervision, and review. Because without documentation, without working papers, it will be difficult for you to review. It will be difficult for you to supervise. So it will help in direction, supervision, and review. It will help in maintaining the quality control. Next, if it is not recorded, it did not take place. If you've done that activity, but if you've not recorded that in working paper, we will assume you have not done that work. Even if you've done that work. Even if you've done that work, but you don't have the proof of that, you don't have a document for that, we will assume you have not done that work. Next, if it cannot be understood, it might as well not have happened. If it cannot be understood, if your working paper is not clear, then we will assume it is not happening. That particular thing has not happened. All right. And lastly, it should enable an experienced auditor with no previous connection to the audit to understand the work done and the conclusions reached. This working papers, it should enable an auditor, an experienced auditor who has no previous connection to this audit. He should be able to understand what you have done and understand the conclusion that you've reached with the help of your working papers. Even if you're not telling them anything, with your working papers, just with your working papers, he should understand that what work has been done and what conclusion has been reached. Great. And last, custody and retention. Who is responsible for the custody and retention of these working papers? Who is responsible? Of course, it is whose property? It is the property of the auditors, right? It is the property of the auditor. So who will be responsible? The auditor himself will be responsible. So the auditor himself, somebody has unmuted themselves. So the auditor themselves, he will only be responsible for what? He will only be responsible for keeping the working papers in a safe manner. Right? He will only be responsible for keeping it in a safe manner so that it doesn't get leaked. Confidentiality is one of the ethical principles, right? You can't leak the information to third parties. All right. Next. So read, they are the property of the auditor. These working papers are the property of the auditor. Next, must be kept securely. It must be kept securely in a secure manner. Next, audit documentation should be retained for 5 years from the completion of audit. From your completion of audit, the audit working papers should be kept in a secure manner. All right. For 5 years at least. You can't throw that documentation, or you can't, discard that documentation before 5 years. Keep that documentation for 5 years. All right. Clear? Any doubts? Any doubts in this chapter? This chapter is done here. Audit planning chapter is done here. Do you have any doubts in this chapter? Or any doubts in documentation? I'm waiting for your confirmations. No doubts? Should we quickly see one question from the exam kit? One second, let me go to one question. All right, we'll see that question after, after your next chapter, after the evidence chapter, because a little bit of that question is actually related to your evidence. So that's why we'll have to see that question after we complete your evidence chapter. Then we can look at that question. Okay. Or look, let me search for another question. No, that question we'll have to see after your evidence chapter. So we'll start evidence chapter, which is one of the most important chapters, and it's very important for you to understand this chapter, because without the understanding of this chapter, you will not be able to understand the chapter procedures. Procedures is very important chapter, and that procedures chapter is based upon this chapter. It is entirely based upon this chapter. Procedures are what? Audit procedures. What are you doing with audit procedures? You're collecting evidence. With audit procedures, what are you doing? You're doing nothing but you're collecting evidence, right? So let's start this chapter and see what does evidence mean. 1 second. All right. So what about evidence? What is evidence? Now, in the example that we took, that let's say you as an auditor, you want to check the sales of the company. Let's say the sales of the company in the P&L is given as 1 crore 10 lakhs. The sales of the company in the P&L is given as 1 crore 10 lakhs. Now that 1 crore 10 lakhs amount, which is being shown in the P&L, that amount is what is a cumulative amount of all the transactions that have happened during the year. So if you want to check that sales amount as to whether that is correct or not, to check whether that amount which is being shown, whether that amount is correct or not, what will you do? First, get the breakup of that amount, right? First, get the transactional breakup of that amount. All the transactions, what is the transactional breakup? Because you can't check that 1 crore 10 lakhs with something, right? You need transaction wise breakup of all the transactions which are there. So you need a breakup of that, and then that list that you get, the list of sales, the list of the breakup that you got, the breakup list that you got, that you can check with sales invoices. So this breakup list and the sales invoices that you've collected, what is this? This is the evidence that you're collecting. For what? Why are you collecting this evidence? You're collecting this evidence to achieve a certain objective. What is the objective? To make sure that the sales amount is correctly recorded. The sales amount which has been recorded, whether that is correct or not, to make sure that you're checking whether the sales invoices has been correctly accounted for or not, right? Okay. Now, this evidence, now this is only one of the examples, right? Sales is only one of the examples. There are going to be a lot of things that in the P&L and in the balance sheet for which you have to collect evidence, right? Evidence, why are you collecting? To check whether the things which have been recorded in the books of accounts, whether that has been correctly recorded or not. That's why you're collecting this evidence. Now, this evidence that you're collecting, this basically forms a base for your audit opinion. The audit opinion that you're going to give, the auditor's conclusion that you're going to arrive at, that audit opinion or auditor's conclusion is based upon this evidence, right? Because this evidence is going to tell you whether the financial statements contain material misstatements or not. This evidence only is going to tell you whether the financial statements contain material misstatements or not. So your audit opinion is going to be based upon this evidence. This is going to be the basis for the audit opinion. Your audit opinion is going to be based upon audit evidence, right? How should this audit evidence be? I told you this probably in the first or the second class. How should your audit evidence be? It should be dash and dash. Can you fill up those dashes? How should your audit evidence be? Your audit evidence should be dash and dash. What are those two dashes? Apeksha says true and fair. True and fair, your financial statements should be true and fair, not the evidence. The evidence that you're collecting should be what? Should be sufficient and appropriate. Have we not seen these two words earlier also? Sufficient and appropriate evidence. The evidence that you're collecting should be how? The evidence that you're collecting should be sufficient and appropriate. It should be what? It should be sufficient and appropriate. Right? Sufficient means what? Sufficient means the quantity. The quantity should be enough. Right? That is the meaning of sufficiency, as to what amount of sales invoices are enough for you. It's related to sampling. It's related to how many transactions are you selecting as a sample, right? That is sufficiency. Sufficient. Appropriateness means what? Like sufficiency is relating to quantity, appropriateness is related to quality of the evidence. Sufficiency is related to what? Sufficiency is related to quantity, whereas appropriateness is related to quality of the evidence. The quality of the evidence, is it appropriate or not? Is it correct or not? Is it good or not? Right? So let's see these things. Come to this slide. See, ISA 500 audit evidence states that auditors should obtain sufficient and appropriate audit evidence to be able to draw reasonable conclusions on which to base the audit opinion. In order to draw reasonable conclusions, you need what? You need sufficient and appropriate audit evidence. And your audit opinion is going to be based upon this particular thing. Okay. What do you mean by sufficient? The necessary quantity must be obtained. Sufficient means what? The necessary quantity must be obtained. What do you mean by appropriateness? The audit evidence, see, must be of necessary quality. That is quantity, this is quality. How do you determine whether it is of good quality or not? You should see, is it relevant and reliable? You should see whether your audit evidence, is it the audit evidence that you've collected, whether it is relevant or reliable. When can you call something relevant now? Quality is determined by whether it is relevant and reliable. But how do you determine as to what is relevant? When can you call something relevant? When it is helping you in achieving your objectives, right? When something is helping you to achieve your objectives, that's when you can call that particular thing as relevant. Otherwise, you can't call it as relevant, correct? Okay. So, see, relevant evidence is required that will enable the auditor to draw conclusions. So, it should be relevant to your particular conclusion. For example, for checking of sales invoices, for checking whether the sales amount has been correctly accounted or not, can you collect the evidence related to the debtors outstanding? The sales and debtors are related. Because of sales only, the debtors have come into existence. But in order to check whether the debtor amount is correct or not, in order to check whether the sales amount is correct or not, will it be correct evidence if you collect, let's say, the debtors confirmations? If you go and collect debtor confirmations for what? For sales, it is not going to be a relevant evidence. It's not going to help you in drawing a conclusion about the financial statements. It's not going to be relevant. And what do you mean by reliable? Reliable, everybody knows. that is that particular evidence reliable? Is it trustworthy? Can you put in your trust in that evidence? Is it trustworthy? That's reliability. Reliability, we will see in the next slide also, as to when do you call something reliable and when do you not call something reliable. But before that, see sufficiency, see sufficient. The necessary quantity must be obtained. Like appropriateness is related to quality, and that quality is determined by both relevance and reliability. Your evidence should be relevant and it should be reliable. Sufficiency is related to quantity. And see, how is that determined? Next, sufficiency is determined by a number of factors like materiality, like materiality, the materiality level that we discussed, that determines whether what amount of evidence is sufficient, right? So materiality, the kind of audit risk involved. If there's high control risk, if there's a higher control risk, if the internal controls are not working, is not operating effectively, there will be a higher control risk. In case there is a higher control risk, you will collect more evidence or you will collect lesser evidence? You tell me. If there is a higher control risk, if there's a higher control risk, will you collect more evidence or will you collect less evidence? When there's a higher control risk, if the control risk is high, then will you collect more evidence or will you collect less evidence? Apeksha says more. Of course, you will collect more evidence. We've seen the effect of the control risk assessment on your audit procedures, right? Correct? We've seen the effect of your effect of the control risk assessment on your audit procedures. We said that if the control risk is high, if the control risk is high, then you will do what? You're going to increase your substantive procedures. If you're going to increase your substantive procedures, if you're going to increase your audit procedures, automatically the quantity of the evidence is going to increase, right? If you're going to increase your audit procedures, the quantity of the audit evidence is automatically going to increase, right? So risk assessment also affects the sufficiency. Materiality affects sufficiency. All right. So that is about sufficient and appropriate. So remember, your audit evidence has to be sufficient and appropriate. Let's see what kind of evidence is more reliable and what kind of evidence is less reliable. For example, you tell me an internal evidence is more reliable or an external evidence is more reliable. Which kind of evidence is more reliable? What is an internal evidence? Evidence which is generated by the client is an internal evidence. Evidence generated by the client, generated by that company, is an internal evidence. Whereas evidence generated by any outsider is an external evidence. So what do you think is more reliable? Is internal evidence more reliable or is external evidence more reliable? Apeksha says external. Why is external evidence more reliable? What's the reason of it? What is the reason? Why do you think external evidence is more reliable? Why is external evidence more reliable? Or why is internal evidence less reliable? Why can't you rely on internal evidence? Yes, very good. Apeksha says the internal evidence can be done what? The internal evidence can be manipulated. The internal evidence can be manipulated, right? What can you do with internal evidence? Internal evidence, the management can change that evidence as per the fraud that they're doing, right? Let's say they want to increase the sales amount. Listen very carefully. Let's say they want to increase the sales amount in the books of accounts. What can they do? They can make fake invoices, fake sales invoices. Sales invoices. Who's preparing invoices? The company, right? The client is preparing that sales invoices. It's an internal evidence. So in order to increase the amount of sales, what can the company do? The company can prepare fake or fictitious invoices in order to just increase the amount of sales in the books of accounts. So that is why external evidence is more reliable. Similar to this, if you apply the similar logic, is oral evidence more reliable or written evidence more reliable? Is oral evidence more reliable or written evidence more reliable? Of course, written evidence will be more reliable. Written evidence will be more reliable. Yes, good. Will the original document be more reliable or a photocopy of the document will be more reliable? Original document or photocopy? Photocopy is nothing but the Xerox. Will the original document be more reliable or the photocopy more reliable? The original document will be more reliable because the photocopy again can be manipulated. Correct? The Xerox documents can be manipulated. Okay. So similarly, see this. See the table on the right hand side. Less reliable and more reliable. What is less reliable? Obtained from inside the entity is less reliable. Obtained from independent sources outside the entity is more reliable. So internal evidence and external evidence. Obtained indirectly will be less reliable. Indirectly means what? Let's say you're getting a bank statement, but bank statement, the bank has not directly sent it to you. The bank statement was first sent, let's say, to the client, and then the client has sent you that bank statement. Let's say you received a bank statement of the client from the bank, but that bank statement was first sent to the client and then to you. So it's an indirect evidence. It is obtained indirectly. It was not obtained directly. If you obtain that bank statement directly, then it is more reliable. Oral representation is less reliable. Photocopy of a document is less reliable. This we've already discussed, right? See the left hand side also quickly. It is talking about sufficient and appropriateness. Sufficient is related to quantity, which is affected by risk, materiality, reliability. Appropriateness is quality, that is determined by two things: relevance and reliability. Whether it is relevant and whether it is reliable. Great. Now, in order to collect evidence, what are the things that an auditor does? Mainly, there are two things that an auditor does in order to collect evidence. They are test of controls and substantive procedures. The sources of audit evidence are majorly two: test of controls and substantive procedures. What do you mean by test of control? Test of control is nothing but test of internal controls. Test of control is nothing but test of internal controls. So sources of evidence is test of controls, tests of internal controls, which we are going to see in a separate chapter altogether in systems and control chapter, and substantive procedures. Substantive procedures is synonymously also called audit procedures. Your checking of sales invoices with the sales breakup in the books of accounts is what? Is a substantive procedure. The example that we took, that you are obtaining, let's say, sales invoices, and those sales invoices you're checking with the breakup in the books of accounts, with the sales breakup as to what is accounted in the books of accounts. That is what? That is a substantive procedure. With the help of substantive procedures, you check whether there are any misstatements in the financial statements. With the help of substantive procedures, you check whether there are any misstatements in the financial statements. You're bothered about the amount which is involved in substantive procedures. Whereas in test of control, what are you doing? In test of control, you're testing the internal control. You're testing the internal control to see whether that internal control is operating effectively or not. In test of internal controls, what are you doing? In test of controls, you're testing the internal controls to see whether those internal controls are operating effectively or not. So there, you're not bothered actually about the amount. There, you're only bothered about whether that control procedure is happening or not, whether that control procedure is correctly being done or not, right? For example, segregation of duties. In order to test segregation of duties, what did I tell you? What can you do? You can go and observe. Observation was one of the procedures, right? You can go and observe whether segregation of duties is happening or not. That is a test of control. That is an example of test of control. Whereas what is substantive procedures? Substantive procedures are procedures employed to check whether there are any misstatements in the financial statements. Those are substantive procedures. Substantive procedures are also synonymously called audit procedures. All right. Let's read about substantive procedures. Substantive procedures. Procedures designed to detect material misstatement at an assertion level, basically to detect material misstatements in the financial statements. It can be test of detail or analytical procedures. It can be either test of detail or it can be analytical procedures. I will tell you what is test of detail. Analytical procedures, do you remember? Analytical procedures, do you remember? What were analytical procedures? What were analytical procedures? What were analytical procedures? You don't remember? Preliminary engagement activity. No, I mean, there can be preliminary analytical procedures, but what are they? What do you mean by analytical procedures, or what do you do? Okay. Evaluation using what? Evaluation using what? Or what are you doing in that evaluation? What do you use in analytical procedures? Give me some main terms. Give me some, the core terms. One is evaluation. Of course, one word is evaluation. What else? Comparisons. What are you doing in analytical procedure? You're comparing, right? How are you evaluating the information? The financial information, the financial data that you have, you're comparing them. Correct? You're comparing this year with last year. You're comparing this year with the budgeted or anticipated. You're comparing this company's financial data with another company in the same industry. You were comparing this company's financial information with the industry averages. Correct? You were doing comparisons with the help of ratios. Don't forget. In analytical procedures, what were you doing? You were doing comparisons with the help of ratios. So those were analytical procedures. So analytical procedures, earlier also when we studied, I told you that analytical procedures is used at every stage of audit. It is used at preliminary stage, the risk assessment stage that we saw in the previous chapter. Now we are seeing analytical procedures again, the same procedure. Procedure is not going to change, but the objective is going to change. There you were doing analytical procedures in order to assess risk. Correct? There you were doing analytical procedures in order to assess the risk involved. Here you are doing analytical procedures to see whether there are any material misstatements in the financial statement. Here you are doing analytical procedure to see if there are any material misstatements in the financial statements. Great. Next, read test of controls. Procedures to test the operating effectiveness of internal control system at preventing, detecting, or correcting the material misstatements. Right? Internal controls, the objective of internal controls is it's to what? Is to prevent, detect, and correct the misstatements. So you are checking how effective is the internal control, how are they working, or you're testing their operating effectiveness to see whether they are preventing, detecting, and correcting the material misstatements. That's test of controls. Okay. Now, we are going to see the substantive procedures in detail, which is also going to be your procedures chapter. Listen very carefully. What are we going to see now? We're going to see substantive procedures in detail. Substantive procedures are also called audit procedures. So what are the different audit procedures that a auditor does? What are the different substantive procedures that he does in order to collect evidence? He does these audit procedures. In order to remember them, remember an acronym REOCAR. In order to remember all of the substantive procedures, all of the audit procedures, remember the acronym REOCAR. REO, R triple IOCAR, not double I. Double I is given there, but we need triple I. We need three I's. So R triple I, R-I-I-I, triple I, three I's, O-C-A-R, REOCAR. What about REOCAR, or what is this REOCAR? This is nothing but an acronym. Remember this acronym. Now, let's let's see this acronym in a more detailed manner. Let's see what is the R first. R is recalculation. R is what? R is recalculation. What do you mean by recalculation? For example, the example that we took, that let's say, let's say, do you know what is a BRS? Do you know what's a bank reconciliation statement? Do you know what is a bank reconciliation statement? What is a BRS? Do you know? You don't know what's a BRS? A bank reconciliation statement. You must have seen BRS in your accounts, in your financial accounting or financial reporting. BRS, bank reconciliation statement. Do you guys need a break before we start audit procedures? Before we start audit procedures, do you guys need a break? Or is it okay to continue? I want your concentration levels to the maximum for this topic. For this topic, for audit procedures topic, and for the next topic, which is assertions. For both of these topic, assertions and audit procedures, I need your concentration to the maximum level. That's why I'm asking, do you want a break? If you want a break, we can break for some time and then we can continue. No response as usual. Tell me something, guys. If you don't need a break, tell me don't know. We don't need a break. Not needed? Okay. All right. So listen. Audit procedures, REOCAR, R triple I O C A R. Now, have you seen a BRS at any time? Okay, let's say you've not seen the BRS. Let's say you're checking the depreciation of the company. Let's say you're checking what you're checking. Let's say the depreciation of the company. Let's say the company has given you the calculation of depreciation that they've done. The calculation of the depreciation, the formula of the depreciation, and then the amounts that they've put in that formula, and then they've got that amount. How have they calculated the depreciation? The entire formula and the entire procedure has been given to you. Now, what will you do? Don't you think you will check whether that calculation is done correctly or not. When you're receiving that depreciation, schedule, when you're receiving that depreciation calculation, don't you think you will see whether additions have been done correctly or not, whether multiplication has been done correctly or not, division has been done correctly or not? You will check whether these arithmetical calculations, have been done correctly or not when you receive that depreciation calculation. Similarly, when you receive a sales invoice from the client, when you receive one of the sales invoices of the client, don't you think you will check whether the number of units into the unit price, which gives you the total amount, that number of units into the unit price, whether that multiplication has been done correctly or not, whether taxes have been correctly calculated or not, the correct percentage, whether the addition of the value of the item plus taxes, whether that addition and probably subtraction of discount, whether that has been done correctly or not. So what are you checking? You are basically again checking the arithmetical calculations. You are checking for the arithmetical accuracy. You are seeing whether arithmetically, whether mathematically, the calculations are correct or not. That is nothing but recalculation. That is nothing but recalculation. Because if the calculation itself is wrong, if the calculation itself is wrong in the depreciation working or in the sales invoice, then there will be a misstatement in the financial statements, right? If the calculation itself is wrong, then there will be misstatement in the financial statements. So that's why you're checking for arithmetical accuracy. You're checking for accuracy of mathematics of the various calculations that the company has done. That is called recalculation. That is called recalculation. The first R. The first R is recalculation. Next I is inspection of records or documents. The next procedure is inspection of records or documents. What do you mean by inspection? Inspection means examination. You're examining, you're checking. For example, the example that we took, that you are taking certain sample of sales invoices, and then you're checking those sales invoices as to whether that sales invoice has been correctly recorded in the books of accounts or not. What are you doing? You're inspecting those sales invoices. You're inspecting that document. You're inspecting that sales invoice. You're inspecting that document. Or, for example, let's say in the last year, the company has purchased a land. In the last year, what did the company do? Let's say the company has purchased a piece of land in the last year. If they have purchased a piece of land in the last year, what is the evidence that you can get for that? For that piece of land, what is the evidence that you can get? The evidence that you can get for the purchase of land is the land deed or the land agreement. The land deed that you have, you can ask the client to give you the land deed to see whether that land deed contains the company's name as the purchaser or not, right? Then the company is the owner of that land. If the company has purchased that land, in that land deed, the company's name should be involved as the purchaser. Then that land is said to be the company's land. The company is said to be the owner of that land if that land deed contains his name. So you're checking what? You're checking ownership. With the help of this evidence, with the help of this land deed, you're checking for ownership as to whether the client is owner of that land or not, right? So that is inspection of records or documents. You're inspecting sales invoices or land deeds, etc. See, read there. It may give inspection of records or documents. The first one, it may give direct evidence of the existence of an asset, right? It may give a direct evidence of the existence of an asset. Ownership, it will give the evidence about ownership, about who is owning those assets, or that a control is operating. From the inspection of records, you can see whether a control is operating. For example, one of the internal controls was authorization, right? One of the internal controls was what? It was authorization. Now, authorization, if you want to check whether that authorization is done or not, for example, let's say every sales invoice is to be authorized by the manager. What can you do? You can inspect that sales invoice for authorization. You can inspect that sales invoice for authorization to see whether that sales invoice has been signed by the manager or not. If there's a signature of the manager involved, then we can say that that manager has checked that sales invoice and then he has signed that. Correct? Okay. So read the inspection of records and documents can give you evidence about existence of an asset. It can give you evidence about ownership of an asset, about whether a control is operating, like authorization, or about cutoff. We will see cutoff in the next slide. Don't worry as to what do you mean by cutoff. That is inspection of records or documents. That is inspection of your records or documents. Great. Next, inspection of tangible assets. In the next I, there are two inspections. One is inspection of records or documents. The other inspection is of tangible assets. What do you mean by inspection of tangible assets? Listen to me carefully. Let's say the company is showing fixed assets in their balance sheet, and under fixed assets, plant and machinery is being shown at, let's say, 25 lakhs. Under fixed assets, let's say the plant and machinery is being shown as 25 lakhs. Now, the plant and machinery which is being shown in the balance sheet, let's say it includes 10 different plant and machineries. Let's say it includes 10 different plant and machineries. So in order to know whether that plant and machinery is actually there or not, or have they included some fake plant and machinery, in order to know whether the plant and machinery which they are saying there are 10 plant and machineries, right? They are saying that there are 10 plant and machineries, and they've recorded all of those 10 plant and machineries in the books of accounts. So in order to know whether all of those 10 are actually there or not, what can you do? You can go and physically inspect them. You can do what? You can go and physically inspect them. You can do an inspection of that tangible asset. You can do what? You can do an inspection of that tangible asset. You can go physically see whether 10 plant and machineries are there or not, because they have to be physically present, right? So that's why you can do an inspection. Similar logic can be applied to inventory. Similar logic can be applied to inventory. Right? Now to inventory, what can you do? Again, inventory is being shown in the balance sheet. That inventory can consist of raw material, work in progress, finished goods. So the amount, the quantity which is being shown in the books of accounts, whether that quantity is matching to the physical inventory or not, what can you do? You can again do physical inspection. Correct? You can again do physical inspection, right? You can go and physically inspect whether that quantity of raw material is present or not, whether that quantity of finished goods is present or not. Similarly, you can also physically inspect cash. The amount of cash which is being shown in the books of accounts, that cash should be physically present. So in order to check whether the cash amount which is being shown in the balance sheet, whether that is correct or not, what can you do? You can go physically inspect the cash amount. See how much is the cash which is there in the cash drawer and count that cash. See whether that is matching with the books of accounts or not. That also is inspection of tangible assets. So what kind of tangible assets can you physically inspect? You can inspect fixed assets. You can inspect inventory. You can inspect cash. All the tangible assets which have physical, physical characteristics, you can go and assess them. You can go and see them. All right. So R was recalculation. What did you do in recalculation? You did the arithmetical calculation to see whether that arithmetical calculation is correct or not. right? I was inspection of records or documents, where you examine the records or documents. I, inspection of tangible assets, where you saw whether the tangible assets are existing or not. You did a physical inspection. So RII, again, one more I is inquiry. One more I is inquiry. As I told you yesterday also, inquiry, I can write it with INQUIRY, or I can write it with E. So I am assuming to write that with I. So INQUIRY. What do you mean by inquiry? Asking questions. Asking questions. Correct? You're asking questions to the management. You're asking information to the management, and their answers is going to give you some evidence, right? Now, this inquiry, this asking of questions to the management, can this be entirely reliable? The answers that you're getting from management, can that be entirely reliable? It cannot be entirely reliable, right? Why? Because the management, if it is doing some fraud, what can they do? They will manipulate their answers. They will manipulate the answers according to that. That is why only inquiry is never sufficient. You need to corroborate that with other evidences. Listen very carefully. Inquiry you're doing, you're asking questions, you're getting answers to your questions, you're getting to know more information, you're getting to know more about the client. But just inquiry is never sufficient. Why? Because only inquiry, if you're only doing inquiry, if you're only asking questions and getting answers for that, then those answers might probably be manipulated. So you cannot only rely upon that. Yes, you can get some information out of inquiry, but that information you check with other evidence. The information that the client is giving to you, that information, you check that information with other evidences. You check that information with you corroborate that evidence, you corroborate inquiry with other evidences, with other procedures. All right. That's about inquiry. So triple I is done. Next is what? O. What is O? O is observation. O is what? Observation. You're observing. Yesterday we discussed, right? What did we discuss yesterday? We discussed that observation, that you will go and observe at the client's place as to whether an internal control is operating or not. You can observe with your own eyes. Observation was also what? It was also a risk assessment procedure. Similarly, inquiry was also a risk assessment procedure, if you remember. In risk assessment procedures also, we had seen AIIO. There also observation was there. Here also observation is there. You're basically going and looking at a process or procedure. Correct? And it may provide evidence that whether an internal control is operating or not. Correct? That's observation. You're going and observing something. So RIIO is done. Next, C. C is confirmation. C is what? C is confirmation. Confirmation means what? Listen very carefully. In confirmations are nothing but external confirmations that you're getting from external parties. For example, let's say the company is showing in their balance sheet the bank account, and in that the bank account balance, and that bank account balance, let's say, is cumulative figure of 4 different bank accounts. Let's say that bank account, the amount which is being shown as at 31st December 2022 in the balance sheet, let's say that bank amount, the bank amount which is being shown in the balance sheet, let's say that's a total figure of 4 different bank accounts, right? So what can you do in order to check whether that amounts are correct or not? You can go to the banker. You can ask external confirmation from them. You can get a confirmation letter from them. You can get what? You can get a written confirmation letter from them as to what was the amount of the balance as at the year end. The banker also accounts for all the transactions and they will also have a balance as at the year end, right? So you're going to the banker, you're getting a confirmation letter from them. You're getting what? You're getting a confirmation letter from them as to what was the balance as at the year end. What was the balance of this particular company in the bank account as at the year end? At the year end, how much was the balance? That is nothing but confirmation. That is nothing but external confirmation. It's called external confirmation. For example, in another area in which external confirmations are used is trade receivables. Trade receivables. Trade receivables, again, in the balance sheet, there will be one amount written as trade receivables, but that will consist of multiple debtors, right? Multiple receivables. So those multiple receivables, which you have a balance as at the year end, you can go to them and you can get an external confirmation letter from them, confirming the balance that they have as at the year end. They are also recording these transactions in their books of accounts, right? If they are trade receivables to you, in their books, you are trade payables. If the company is accounting as trade receivables, that opposite party, that debtor, will record as a trade payable. But the amounts should match, right? So you are taking an external confirmation from the opposite party where he's confirming the balance as at the year end. These are confirmations or external confirmations mainly used for debtors, trade receivables, trade payables, your bank accounts, the balance in the bank accounts. For all of these, external confirmations can be used. So read confirmation. Usually consists of obtaining confirmation regarding balances or representations made by management directly from an external third party. You are getting this confirmation directly from that party. It should not be the case that that banker is sending the confirmation letter to the client and then you're receiving it. No, ask the banker to directly send it to you. Similarly, ask the debtors or ask the trade receivables to directly send that external confirmation to you. So that's confirmation. I hope it's clear. Confirmation letters or external confirmations. Next, A, analytical procedures. Analytical procedures we've already discussed, right? What are analytical procedures? Comparisons. You have some financial data. You're using comparison techniques with the help of some ratios and then identifying any unusual relationships, any unusual fluctuations, and trying to get answers to why that unusual fluctuation or variance is there. If you don't get a proper answer to that unusual fluctuation or variance, probably there is some error or there is some fraud in the accounts. Correct? So that is nothing but analytical procedures, which we've already seen in our previous chapter. Next, R. One more R. The last R, reperformance. The last R is about reperformance. What do you mean by reperformance? You're reperforming some procedure. For example, let's say the client has prepared a BRS, but now let's say you are reperforming that. You are performing BRS again. You are doing BRS again. You are preparing bank reconciliation statement again on your own, and then you will check with the BRS of the company to see if it matches. So that's a reperformance. You are performing it again, that procedure. Like for example, BRS, bank reconciliation statement, or let's say depreciation calculation. If you are doing it on your own again, then that's a reperformance. In recalculation, what were you doing? You were taking their calculation and checking for arithmetical accuracy. Don't get confused. In recalculation, how is recalculation and reperformance different? In recalculation, you were obtaining their BRS, you were obtaining their depreciation calculation that they have calculated and checking whether arithmetically that is correct or not. That is recalculation. to check whether the addition, subtraction, division, multiplication is correct or not. But what is re-performance? Re-performance is you yourself preparing that thing by scratch, from scratch. You, by yourself, you're preparing that particular thing from scratch, right? That is re-performance. Like you preparing BRS on your own, or you preparing depreciation calculation on your own. That is re-performance. Clear? Any doubts in these audit procedures? Any doubts in these audit procedures? And I hope you're writing this down in your notes, because these audit procedures, this RIO-CAR, this acronym is not going to be there in your books, in your study text. This acronym is made by me. So please write down that acronym and write down each procedure against it. All right. So what we'll do now is we'll take a break. We'll take a small break, and after the break, we will again come back and go to the next important topic, which is financial statement assertions. These audit procedures, as I told you, is very important. Assertions are also very important. So after the break, we will come back and we will continue to discuss assertions. So take a break and come back. I will switch on a timer also as usual. Okay, we are back from the break. And before the break, what did we discuss? We discussed audit procedures. We discussed the substantive procedures as to what substantive procedures do you use in order to collect evidence about the misstatements in the financial statements, right? To see whether there are any misstatements in the financial statements. What procedures did you use? I'm again revising, because this is very, very, very important. You cannot forget them. These procedures are only going to be used in your procedures chapter also. So you have to remember there's no other choice. Remember RIIOCAR, RIO-CAR. R, recalculation. I, inspection of records or documents. I, inspection of tangible assets. I, inquiry. O, observation. C, confirmation. A, analytical procedures. R, re-performance. So remember them, don't forget them. Now, why are you doing these procedures? What is the objective of these procedures? What are you achieving out of these procedures? Or what are you checking because of these procedures? What is being achieved? Or what is the objective? The objective that is being achieved is nothing but assertions. The objective that you're achieving out of these procedures that you're doing are nothing but the financial statement assertions. Okay, I'm sure this must be a new word for you as to what is assertions, but listen to me carefully for the next 15 minutes. Keep everything aside that you're doing and listen to me very carefully, because these are very, very, very important in order for you to understand as to what does an auditor do. Without understanding these, you will not understand any audit procedure. Okay, listen. What are assertions, first of all? What do you mean by assertions, or what do they mean? Assertions are nothing but claims made by the management. What are assertions? assertions are nothing but the claims made by the management. What do you mean by that? In the financial statements, who is preparing financial statements? The management is preparing the financial statements, right? The management is responsible for preparation of financial statements. Now, when management is preparing the financial statements, let's say in the financial statements, trade receivables is being shown at 20 lakhs. Let's say in the financial statements, the trade receivables is being shown at 20 lakhs under current assets. So when you look at this particular thing in the financial statement, what is this? This is nothing but the management is making an assertion. The management is making an assertion, management is making a claim that trade receivables is a current asset, right? Management is making an assertion that trade receivable is a current asset. This is the amount of trade receivables. This is the complete amount of trade receivables which they have to receive. They are making an assertion that these are the trade receivables which are existing, and this is the value of the trade receivable. They're making various assertions like these. They're making various claims like this, right? For example, let's say they're showing land as 15 lakhs under fixed assets. So what claims is the management making here then? The management is making a claim that they are owner of a land. Then only they can record that as their fixed asset, right? When can you record that land as the fixed asset of the company? When the company is owner of that land. So the management is making a claim that the land is being owned by the company, that the land is going to be a fixed asset. That means it's going to be, the benefits out of it are going to be reaped more than 1 year for a period which is exceeding 12 months. That's why it's a fixed asset, correct? So they are making a claim that it's a fixed asset. They are making a claim that they are the owners of that land, correct? They are making the claim that the land value is 10 lakhs or 15 lakhs, whatever value they are showing. They are making a claim that the value of the land is so and so. They are making a claim that the land actually exists, physically exists. That is why they have recorded that as land, right? So all of these claims the management is making. All of these assertions the management is making. Assertions are nothing but claims. And as an auditor, you are doing nothing but checking for these assertions. By doing the procedures that we saw in the previous slide, by doing the various procedures that we are doing, that we saw in the previous slide, the objective of the auditor is nothing but to check for one or more of these assertions. The assertions that the management is making, you're checking for these assertions in the balance sheet and P&L. Okay. With this introduction that assertions are nothing but what? Assertions are nothing but the claims made by the management in the P&L and balance sheet, right? And as an auditor, what are you going to do? As an auditor, you're going to check these claims. You're going to verify these assertions. You're going to check these assertions. Okay, let's read financial statements assertions. For each item in the financial statement, management is making assertions, right? For each item in the financial statements, for sales, purchases, rent, for fixed assets, current liabilities, for each item under them, the management is making certain claims. The management is making assertions. Okay. Now, these assertions can be divided into two groups: the account balances and the transactions and events. Account balances are what? Account balances are nothing but balance sheet items. Account balances are nothing but what? They're nothing but balance sheet items. Your balance sheet items are going to be called account balances. Your P&L items are going to be called transactions and events. The balance sheet items are going to be called account balances, and the P&L items are going to be called transactions and events. Okay. First, we'll discuss about the balance sheet items. Then we will go to the P&L items. If you understand balance sheet items completely, understanding P&L items is going to be very easy, right? So concentrate when we discuss about the balance sheet items. Account balances, which are nothing but the balance sheet items. So when you're looking at the balance sheet and when you're looking at the various balance sheet items like fixed assets, trade receivables, bank and cash, or your inventory. So when you're looking at these account balances or your current liabilities like your trade payables, the loan outstanding, any item in your balance sheet, what assertions do you check as an auditor? You check for CEAVOP, CVOP. Remember, you check for what? You check for CVOP, CEAVOP, CVOP. What is CVOP? C is for completeness. C is for what? C is for completeness. What are you checking here? Here, basically, you're checking whether everything which is which has happened, whether that has been completely recorded or not in the books of accounts. For example, let's say in the last year, the company has purchased 12 different plant and machinery. If the company has purchased 12 different plant and machinery in the last year, whether all 12 of them have been recorded in the books of accounts or not is nothing but checking for completeness. Whether all 12 of them, all 12 plant and machinery, whether all 12 of them have been recorded or not, that is nothing but checking for completeness as to whatever has happened or whatever is there, whether that has been completely recorded or not in the books of accounts. That's completeness. That is checking for completeness, right? How will you do that? By using audit procedures. How will you check for completeness? You will check for completeness by using audit procedures. What are you going to use? You're probably going to inspect the purchase invoices of those plant and machinery. Those plant and machinery which were purchased, you will check how many purchase invoices are there for plant and machinery. Let's say you got 13 invoices. Let's say you got 13 invoices. You will check whether all 13 of them have been recorded or not, and whether the amount has been completely recorded or not. The amounts of the invoice, that also whether that has been completely recorded or not. Because if there are 13 invoices of purchase of plant and machinery, but only let's say 10 are recorded in the books of accounts, that means that balance is not complete. If there are 13 invoices, if there are 13 purchase invoices of the plant and machinery, but in the books of accounts only 10 have been recorded, that means what? That means the balance of that plant and machinery is not complete. That has not completely been recorded. Correct? So that's a check for completeness. You are checking whether completely everything has been recorded or not. The next point, existence, is nothing but the reverse of completeness. What is existence? In existence, you are going to check whether what has been recorded, whether that actually exists or not. In completeness, what were you doing? In completeness, you were seeing whether which is there, that has been completely recorded or not. In existence, what are you doing? Whatever has been recorded, whether that actually exists or not. For example, let's say the company has recorded 20 plant and machineries. A total of 20 plant and machineries are being shown in the balance sheet. Whether all of 20 of them are existing or not, or have they included some fake plant and machinery? What is check for existence? You are basically checking whether everything that has been recorded in the balance sheet that actually exists or not, or have they included some fake plant and machinery in order to overstate their assets? In order to increase the amount of assets, have they included some fake plant and machinery, some fictitious plant and machinery, which is actually not existing, which is actually not there, which is actually not present, but they have still included that amount in the balance sheet, in their books of accounts, to just increase the value of their assets. To do what? To increase the value of the assets, they've included the value of that plant and machinery, which is not even existing. So that is a check for existence. How will you check for existence? Can you tell me what procedure will you use in order to check for existence? I hope you can answer that. Out of Rio car, out of the different procedures that you saw, which procedure can you use in order to check for existence? Which procedure? I got one answer. Inspection. Okay. Nitin says observation. Okay. Inspection of what, Vandita? You said inspection. Inspection of what? Because there were two types of inspection. If you remember, there were three eyes. There were two inspections and there was one inquiry. Nitin says observation. Observation is used for what? Observation is used for internal controls, to see whether an internal control is properly existing or not. You're going and observing a process or procedure. Observation is not used for checking the existence of the asset. What is used? Inspection of tangible assets, guys. Inspection of tangible assets. Yes, correct, Vandita. Right? We saw inspection of tangible assets, right? What did I tell you? You're going and inspecting whether that tangible assets is actually existing or not. That is inspection of tangible assets. You're going and checking whether that inventory actually exists or not in the warehouse, whether that inventory is present or not. Similarly, whether cash amount which is being shown in the books of accounts, whether that cash amount exists or not. That is the check for existence. You're checking for existence with the help of inspection of tangible assets. So using the audit procedure of inspection of tangible assets in order to check for existence. And what are you checking in existence? Whatever has been recorded in the books of accounts, whether that actually exists or not. That's existence. So completeness and existence. See, both are reverse of each other. Completeness, existence. Next, A, accuracy. What is accuracy? You want to check whether the amount which is being shown, whether that has been calculated accurately or not. Basically, the arithmetical calculation, the addition, subtraction, division, multiplication, whether those have been done correctly or not, that is check for accuracy. That is a check for accuracy. You're going to check calculations. Which procedure? Of course, recalculation. The recalculation procedure. Next, V, valuation. You want to see whether the value that is being shown, whether that is appropriate value or not. The value of the land which is being shown, or the value of the trade receivables which is being shown, or the value of the inventory which is being shown, whether that value is the appropriate value, whether that value is the correct value. The management is making an assertion that the land is valued at 15 lakhs. But you as an auditor, you need to check whether that value is correct or not. That is nothing but a check for valuation. So accuracy, valuation. See, accuracy and valuation are actually closely related to each other. But they are different from each other, right? Yes, they are related, but they are different. In accuracy, you are bothered about what? You are bothered about the mathematical calculations. In accuracy, you are bothered about the mathematical calculations, the arithmetical calculations, addition, subtraction, multiplication, division. You're bothered about the calculations. In valuation, you're bothered about the value of the item, whether that value is appropriate or not. Right? Okay. Next, O, rights and obligations. O for obligations. Why have we written O there? O for obligations. Rights and obligations. What do you mean by rights and obligations? In the balance sheet, what is the management doing? The management is listing down the assets and listing down the liabilities. When can you list something down as your asset? When you have ownership rights over that asset. When can you account for a land or a building or a plant and machinery in your balance sheet when you're the owner of that land, when you have ownership rights over that. When you have ownership right over that, then only. Correct? If you don't have the ownership rights, you're, let's say, just holding that asset. Let's say you have some inventory. That inventory is actually not yours. That inventory is actually not yours. Let's say you're holding some third party's inventory on their behalf. Can you show that inventory in your balance sheet? No, because that inventory, you're not the owner of that. You don't have the ownership rights over them. So you pick up any assets, any fixed asset or current asset, the company should have ownership right. The company should have ownership right over that asset. Then only they can show that asset as their asset. Similarly, liabilities, when can they show a liability? They can show a liability as their liability when they have an obligation for that. When they have a present obligation, then only they can show that as a liability, right? When they are having an obligation. If they don't have an obligation, they will not be showing that as their liability. If it's not their obligation, it cannot be shown as their liability, right? So rights and obligations. Over assets, the company should have ownership rights. Over assets, the company should have ownership rights. Over liabilities, the company should have what? The company should have obligation for those liabilities. So ownership, so rights and obligations. Okay. Next, P, presentation and classification. P is presentation and classification. In the balance sheet, items have to be presented and classified as certain things, right? For example, plant and machinery has to be classified as fixed assets. Inventory is classified as current assets, right? Plant and machinery is classified as fixed asset. Inventory is classified as current asset. Similarly, your trade payables are classified as your current liabilities. So presentation and classification also you need to check. Correct? You need to check whether the presentation and classification is correct or not. Whether they have classified and presented everything correctly or not in the balance sheet. So CWOP, CEAVOP, CWOP, C, completeness, E, existence, A, accuracy, V, valuation, O, rights and obligation, and P, presentation and classification. All right. Sorry for that disturbance. There was some electricity outage. Let us continue. Let me share this slide. 1 second. Yes. So we were discussing about financial statement assertions, right? We discussed already about all the account balances. We've discussed about the balance sheet items. In balance sheet items, we've seen CWOP. Remember CWOP? C for completeness, E, existence, A, accuracy, V, valuation, O, rights and obligation, P, presentation and classification. Now, like we saw balance sheet items, there are some claims or assertions that the management makes for P&L items also. And you as an auditor, you're doing audit procedures in order to check for one or more of these assertions. For P&L items, P&L items are called transactions and events. Now, like you saw balance sheet items, now we will be seeing P&L items. For P&L items, again, see the first one. Okay, 1 second, we have a doubt. So Vandita is asking, can you explain valuation with an example? Yes, I can. For example, let's say the value of the plant and machinery, let's say in the last year, let's say they have revalued it. There was a revaluation last year of plant and machinery, and they've revalued it to a new amount. Let's say they've revalued the plant and machinery to fair value. to the market value. This have you seen in your accounts? Vandita, have you seen revaluation in your accounts? Because if you've not seen revaluation, I will take another example. If you've seen revaluation. So when there's a revaluation, what does the company do? The company revalues the value of the fixed asset to a new amount, which can be the market value, which can be the fair value. Correct? So in that case, you need to check whether that value which the company has adopted, whether that value is correct or not. And how will you see whether that value is correct or not? You will check probably with a valuation expert. You can take the help of a valuation expert. He will give you a report. That expert will give you a valuation report. And with that report, you can check whether that value, that the revaluation that has been done, whether that has been done correctly or not. This is one example. Or let me give you a more simpler example. Let's say the company had purchased the plant and machinery during the last year. Let's say the company had purchased the plant and machinery during the last year. So you should check whether the value of that plant and machinery has been correctly accounted for or not. If you remember your accounting standard, what does your accounting standard say? What all cost should be included in the value of that plant and machinery? All the cost incurred in order to bring that asset into the working condition should be included in the value of that plant and machinery, right? That means the price of that plant and machinery, the transportation cost of that plant and machinery to the factory, the installation charges, any installation charges or installation expenses that you've incurred in order to install that plant and machinery at the premises of the client, all of that should be included in the value of the plant and machinery. So as an auditor, you should check whether that all of those values have been included or not. So that again is a check for valuation. That again is check for valuation. Clear? One second, the chat box is not opening. Oh. How is it different from accuracy? In accuracy, you're only checking addition and subtraction. You're not bothered about the value. For example, the same example where you're checking whether that fixed assets value, whether it has included all the amounts which have been incurred in order to bring it to the present condition, you are checking that. But you're not checking the addition, the subtraction, the multiplication, the division. If you're checking that, then it is checking for accuracy. If you're checking only the value, then it is valuation. And as I told you, both of them are closely related to each other. You'll probably do both of them together in order to check whether something is correct or not. For example, when you're checking for that particular plant and machinery, the closing value, what will be the closing value? It will be the historical cost minus depreciation. Now that amount of depreciation or the amount of historical cost is valuation. But when you're checking for the addition or reduction of depreciation, the subtraction of depreciation, that is checking for accuracy as to whether they've calculated that subtraction correctly or not, whether they have done that arithmetical calculation correctly or not. Clear? Okay. Now we'll move to the P&L items. See the P&L items. P&L items are called transactions and events. Balance sheet items are called account balances. P&L items are called transactions and events. The first one remains the same. Completeness. What do you check in completeness? Every transaction that has occurred, whether that has been completely recorded or not. Basically, if you have, let's say, 150 sales invoices during the month, let's say you are checking one particular month, and in that month there were 150 sales invoices, whether all of those 150 sales have been recorded completely in the books of accounts or not. That is checking for completeness, whether whatever has happened, whether all the transactions and events which have happened, whether all of them have been completely recorded or not. That is a check for completeness. It is similar to the completeness of balance sheet items, right? So completeness is same. Next, occurrence. Occurrence is similar to existence. Occurrence is again similar to existence. Your balance sheet items, we were checking, right, that whatever has been recorded in the balance sheet, whatever is there in the balance sheet, whether that has actually occurred or not. Whether that has actually occurred or not, you were checking that. Sorry, whether whatever has been recorded in the balance sheet, whether that actually exists or not, you were checking that. That the plant and machinery, the 10 plant and machineries which have been recorded, whether in reality, in existence, in physicality, whether there are 10 plant and machineries which are physically existing or not. You were checking for their existence. Similarly, here, all of the transactions and events which have been recorded, whether they've actually occurred or not, that you're checking. Just similar to existence, here you can't call transaction and events exist. Like plant and machinery exist, but sales occur, purchases occur. Correct? Similarly, rent expenditure occurs. So whatever has been recorded, whether that has been actually occurred or not. That's why the word existence has been changed to occurrence. Because for balance sheet items, you can call it as existence. Like plant and machinery exists, trade receivables exist, land exists. You're checking for their existence. Inventory exists. But for your P&L items, you can call it occurrence because they occur. Sales occur. Purchases occur. Right? So the same concept, it's just that they're being called occurrence. So in completeness, you're checking whether all the transaction events which have happened, whether that has been completely recorded or not. For occurrence, you're checking whether what has been recorded has actually occurred or not. Or did they include any fake sales? Did they include any fictitious sales which has actually not occurred only? Did they include any fake sales or fictitious sales which has actually not occurred only? So that's occurrence. So C for completeness, existence has become occurrence, accuracy remains the same. Again, you're checking for arithmetical calculations, you're checking for addition, subtraction, division, multiplication. A remains the same. There's no valuation here. You don't value your P&L items. So there's no valuation here. There's only accuracy. O is cut off. O is not rights and obligations, but O is cut off. What do you mean by cut off? Listen very carefully because important concept and a new concept. What is cut off? Everything which has occurred during the year should be recorded in this year. Everything that has occurred in the next year should be recorded in the next year and not in this year. Right? Everything, for example, let's say a sale contract was entered into on 30th December 2022. On 30th December 2022, let's say a sale contract was entered into. And this sale contract, which was entered into on 30th December 2022, let's say the goods were sent on 2nd January 2023. The contract was entered onto on 30th December 2022, but the goods were delivered, the goods were sent on 3rd January 2023. And the invoice was sent on 3rd January 2023 along with the goods. So when should you record these sales? This sales, should you record in 2022 or should you record in 23? When should you record this sales? You tell me. This particular example of sales, when should you record? In which year? Again, I'm repeating. What are you doing? The sales contract was entered into on 30th December 2022. On 30th December 2022, the sale contract was entered into. With respect to the sales contract, the goods were delivered, the inventory, the goods, the finished goods were sent to the opposite person on 3rd January 2023. Invoice was also sent on 3rd January 2023. So when do you record this transaction? Do you record this transaction in 2022 or do you record this transaction in 2023? This is your accounting knowledge. This is your accounting knowledge. When do you record this? When do you recognize the revenue? Okay, Khadija says 2023. Nitin says 2023. Can you tell me what is the reason why 2023 and not 2022? Can you tell me the reason of why are you recording that in 2023 and not in 2022? Yes, very good, Nitin. Revenue is recognized when? Revenue is recognized when the control over that goods have been passed, right? Revenue is recognized when the control over that goods has been passed. The control has been passed in 2023. Yes, the sale contract was entered into in 2022, but the control over the goods have been passed in 2023, next year. So you record that sales transaction also next year. You record this as a sales transaction in 2023 and not in 2022. So this is nothing but cutoff. You should look for such transactions which have happened near the year end, right? You should look for the transactions which have happened near the year end to see whether they have been accounted for in the correct year or not. To see whether they have been accounted in the correct year or not. The transactions and events which have happened in this year should be recorded in this year, and transactions and events which have happened in the next year should be recorded in the next year, right? That is nothing but cutoff. That is nothing but cutoff. And last, presentation and classification. Presentation and classification. Again, this also we know. For example, we have a format of P&L, right? Sales minus cost of sales, you get gross profit. Then you reduce selling, general and administrative expenses. Then you get net profit before interest and taxes. Then you reduce finance cost and taxes. Then you get net profit. So we have a format, specific format of P&L. Of course, the company should follow that, and the company should follow correct classification, correct presentation, and also the correct classification. What do you mean by classification? For example, your rent of office building, can you classify that as cost of sales? Your rent of office building, can you classify that as cost of sales? Or can you classify that as finance cost? No, it's a rent for your office building. You should classify that as a general and administrative expenses. Correct? That is a general and administrative expenses, the rent for your office building. So classify that as a general and administrative expenses and not as cost of sales or not as finance cost. Similarly, interest expenditure, can you classify interest expenditure as a selling expenses? No, you have to classify that as a finance cost. So see whether the classification has been done correctly or not. Presentation and classification. All right. So these are the various assertions that you check as an auditor. Any doubts in them? Anything that you've not understood? Anything that you've not understood in these assertions and classifications? Sorry, assertions or procedures, the substantive procedures or audit procedures. One second. Let me try to connect back to the Wi-Fi because the electricity is back. Yes. So we are back on Wi-Fi. Let me share my screen. Okay. So assertions are done. the substantive procedures. We've seen audit procedures that an auditor does. And with those audit procedures, what objectives is he having? He's having objectives of checking these assertions. Assertions, remember CVOP, CEAVOP. Similarly, when you remember CVOP, remembering P&L items is going to be easy because completeness is the same. Completeness remains the same. Existence becomes occurrence. Existence, the word existence become occurrence, but the concept remains the same. So completeness is remaining the same. Existence is becoming occurrence. The concept is same. Accuracy is accuracy. O is cut off. Excuse me, guys. O is cut off. O has been changed. Valuation is not present. And P is same, presentation and classification. P is the same, presentation and classification. So if you remember CVOP, remembering P&L items will be very easy. Okay. Now, next, let's go to the next concept of sampling. Let's go to the next concept of sampling as to what is sampling. Now, what is sampling? As we know already that an auditor cannot check 100% of the transactions. An auditor cannot check 100% of the transactions. So what he has to do? He has to select less than 100% of the transactions, and he has to select as to which transactions is he going to check, and those transactions only he will check. For example, let's say in Reliance Industries Limited, in the last year, there were 1 crore sales transactions. Let's say in Reliance Industries Limited in the last year, let's say there were 1 crore sales transactions. So as an auditor, it will obviously be not possible. It's practically impossible to check 100% of the transactions, right? Correct? It is practically impossible to check 100% of the transactions. So what does the auditor do? The auditor selects a few transactions out of those transactions and tests them. He examines those selected transactions only. And one of the selection methods is sampling. One of the selection methods is sampling. When can you call that selection method as sampling? When each item has a chance of selection. Listen very carefully. When each item has a chance of selection, then only I can call that as a sampling. Otherwise, it cannot be called as a sampling. For example, if I'm the auditor of Reliance Industries Limited, and if I am saying that I will select the top 50 transactions, I will select the top 50 transactions based on their value. So whichever is the maximum value transactions, only those transactions are being selected. Does every transaction have a chance of selection? I as an auditor, I am saying I'm going to check only the top 50 transactions as per the value. Whatever transactions have the highest values, only the top 50 transactions I'm going to check. Then is that called sampling? No, that is not called sampling. Why? Because for selection method to be called as a sampling method, every item should have a chance of selection. If every item has a chance of selection, then only I can call that as a sampling. If I'm selecting the top 50 transactions, it's not called sampling. If I'm selecting the top 50 maximum value transactions, it will not be called as a sampling. Be careful. When can you call a specific selection as sampling? Only when you are giving every item a chance of selection. When you're giving every item a chance of selection, then only you can call that as a sampling. Correct? Okay. Then only you can call that as a sampling. When every item has a chance of selection. Read, audit sampling involves the application of audit procedures to less than 100% of the items. So you are applying those procedures to less than 100% of the transactions, not 100% of the items within a class of transactions, such that each has a chance of selection. Each transaction should have a chance of selection. correct? Each transaction should have a chance of selection. Then only you can call that as a sampling. Okay. Next, audit sampling is usually preferable to testing all items because, see, it would be prohibitively expensive and time consuming to test every single item. To test every single item which is there in the population, right? Every single transaction, it will be very expensive and time consuming. Next, users of the financial statements are looking only for reasonable assurance, right? And not 100% accuracy. They're not looking for absolute assurance. They are not looking for absolute assurance. They are looking for reasonable assurance. Anyways, they're not looking for 100% accuracy. Next, full substantive testing of the accounting records will not verify that all transactions are recorded. Even if you check 100% of the transactions, that still will not tell you 100% that all the transactions have been recorded. Probably there were some transactions and events which have occurred, but they have not recorded them. So even if you check 100% of the transactions, there might be something that you will miss. It will still be, it can still be a possibility that there might be a misstatement and you will not be able to identify them. It's not necessary that if you check 100% of the transactions, you will identify all the misstatements, right? It does not prove completeness even if you check 100% of the transactions. Okay. But in certain situations, audit sampling is not appropriate and you have to do 100% testing. In certain situations, audit sampling is not appropriate and you have to do 100% testing. What are those situations? Those are given in the next paragraph. See, however, audit sampling is not appropriate when the population is small. When the entire sales transactions in the year are, let's say, only 200. In the entire year, the sale transactions are only 200. Then the population itself is small, right? The entire population is only 200 transactions. So if the entire population itself is small, then don't do sampling. Or for example, let's say in the last year, the company has purchased fixed assets. There were only 10 fixed assets which were purchased. There were only how many? There were only 10 fixed assets which were purchased. If the company has purchased only 10 fixed assets in the last year, will you again do a sampling and check only 2? No, right? You will check all the 10 because there are only 10 transactions. There are only 10 purchase of fixed assets. So you will check only 10 transactions and you will not do sampling there. Next, see the next bullet. All transactions in a particular area are of great monetary significance. Every item in the population is of great monetary significance. Every item is of a high value. This is generally applicable to what? This is generally applicable in the fixed assets area. In the fixed assets area, the purchase of fixed assets, every item, every purchase or every transaction will be of a great monetary significance, will be of great value, will be of a high value. So in that case, what do you do? In that case, what do you do? In that case, since every item is of great monetary significance, you will not do sampling. You will check 100% of the transactions. And lastly, when the population is non-homogeneous. What do you mean by population being non-homogeneous? Population non-homogeneous means that every transaction is different from another transaction. They're not same. Every transaction is different from the rest of the transaction. Then how can you select them? How will you select the sample? If every transaction is different, then you cannot select a sample. Correct? So in that case also, you will not select sampling. You'll have to do 100% testing, because if you select the sample also, it will not be representative of the population. In the population, every transaction is different. In the population, every transaction is different. So you will not be able to select any transaction. Correct? If you select any transaction also, it will not represent the entire population, because all other transactions are different. Okay. So that is third case in which sampling is not possible. All right. Now, when you're designing the sample, there are mainly two types of sampling methods. What are these two types? One is statistical sampling, the other is non-statistical sampling. One is statistical sampling, the other is non-statistical sampling. What is statistical sampling? You're using statistics. In statistical sampling, what are you doing? You're using statistics. In statistics, you must have studied the concept of probability. Correct? In statistics, you must have studied the concept of probability, right? So if you're using probability theory and random selection theory, two theories. If you're using random selection theory and probability theory, then you will be using statistical sampling method. If in that method you're using random selection theory and probability theory, then you will be using what? Statistical sampling method. All right. Any other method will be a non-statistical sampling. So remember, when is it a statistical sampling method? When there is use of random selection and probability theory. When there is random selection and probability theory, that's when you're using statistical sampling method. Remember those two things, random selection and probability theory. Okay, let's see the different types of sampling methods under statistical and under non-statistical. What are the different types of methods that you can use under statistical and under non-statistical? See, under statistical, there are three: random selection, systematic selection, monetary unit selection. There's three. One is random selection, second is systematic selection, third is monetary unit selection. What is random selection? You're using random generator tables or random number generators, and with the help of random number generators or the random number tables, you're selecting the transactions. Right? Those random number generators will give you random numbers, and with respect to those random numbers, you will select the transactions. You will list down all the transactions. Let's say there are 1,000 sale transactions. You list down all the 1,000 sale transactions, right, with serial numbers. Let's say the random numbers are giving you 5, 15, 18, 20, 45. So you will select these transactions from the list. You will select fifth transaction, 18th transaction, 20th transaction, 45th transaction, and you will test those transactions, because those are the numbers which have been given by the random number generators. Right? So that is random selection. That is random selection. Next, systematic selection. What is systematic selection? Systematic selection is you will be deciding a constant interval, and that's how the items will be selected. For example, let's say you decided that every 20th item needs to be selected. Let's say you decide that every 20th item needs to be selected. The first item will be selected randomly. Let's say the first item that you selected is fourth item. The first item will be selected randomly. Let's say the first item that you selected is fourth item. Then after fourth, every 20th is being selected. So which items will you test? You are selecting for your sample fourth, 24th, 44th, 64th, 84th, basically every 20th transaction. That is called systematic selection. Now, how is systematic selection a sampling method? Does every item has a chance of selection? In systematic selection, does every item have a chance of selection? Yes, every item has a chance of selection. Why? Because the first item is being selected randomly. The first item can be anything. The first item can be 1, the first item can be 50th, the first item can be 30th. Since the first item is selected randomly, every item has a chance of selection. Right? Okay. That is why systematic selection, where every 20th balance or every 50th balance or every 30th balance is being selected, that is also a sampling method. All of these are sampling methods because every item will have a chance of selection in these. In these, every item will have a chance of selection. Okay. Next, monetary unit selection. Monetary unit selection. What is monetary unit selection? In this, the items will be selected based on their monetary values. In this, what will happen? The items will be selected based upon their monetary values. Here, every 20th transaction is not selected. Then what is selected? Every $100th or every 20th dollar or every 120th dollar will be selected. Every $100th or every 20th dollar or every 50th dollar, depending on the value of the item that is being selected. If the value of the item is high, there will be more chances of that being selected. There will be more chances of that being selected if the value of the item is high. Correct? Okay. That is monetary unit selection. So remember, you can see an example of monetary unit selection from your study text. They've given you a detailed example of what do you mean by every $100th being selected or every 150th dollar being selected. What is the meaning of that? They've given a detailed discussion about that. So you can look at your study text for a detailed example of monetary unit selection. So under statistical, there are 3: random, systematic, monetary unit. So random selection, systematic selection, monetary unit selection. Under non-statistical selection, under non-statistical sampling method, there are 2. Haphazard. What is haphazard? Haphazard is you will not follow any structured technique. You're not following any technique. You're not following any random number generators or any random number tables. You're not going to follow any technique. You're just haphazardly, without any technique, without any structure, you are going to select items. That is haphazard selection. That is haphazard selection. Correct? Okay. Next, block selection. What is block selection? Instead of selecting one transaction, you're going to select set of 2 transactions which are side by side. That is block selection. Instead of selecting one transaction, you're going to select a block of 2 transactions, a block of 2 continuous transactions, a block of 2 transactions which are one after the another, instead of selecting just one. So see, block selection. This involves selecting a block of continuous items from the population that is next to each other. Right? You're selecting continuous items which are next to each other. That is a block. That's called a block. So you're selecting a block. To reduce sampling risk, many blocks should be selected as valid references cannot be made beyond the period or block examined. All right, that's block selection. Next, when non-statistical methods are used, the auditor uses judgment to select the items to be tested, right? His own judgment is being involved in the selection of the items. While this lends itself to auditor bias, it does support the risk-based approach where the auditor focuses on those areas most susceptible to material misstatement. The areas which are more susceptible, the areas where he thinks that there's more possibility of misstatements, he will select items from those areas in the case of non-statistical sampling method. All right. Clear? Or do you have any doubts in sampling? Clear with sampling? Clear with sampling? Waiting for your responses. No doubts? Okay. So sampling is done. These were the different methods through which you can take out a sample of transactions and test them rather than testing the 100% of transactions. Great. Let's move to the next topic, which is about relying on the work of others. Relying on the work of others. Sometimes, as an auditor, what do? You rely on somebody else's work. What are you doing? You are relying on the work that somebody else has done. For example, you rely on the work of experts. You rely on the work of experts. Sometimes you rely on the work of internal auditors, and you rely on the work of the auditors of service organizations. You rely on the work of the auditors of these service organizations. So these three types of dependency will be seen: experts, internal auditors, and service organizations. So under relying on the work of others, we are going to see basically three different sub points: others, internal auditors, and the service organization. Let's first discuss experts. Let's discuss experts first. Who are these experts? Listen very carefully. Let me explain you first. We already took an example, right? That let's say in the last year, the company has revalued their plant and machinery to the fair value, to the fair market value. Now, we are not valuation experts, right? We are auditors. We are not valuation experts. There will be separate people, there'll be separate firms whose job itself is to value for various items, and they're called valuers. They're called valuers. They'll be experts in that field. They'll be experts in valuing for plant and machinery, for land, for building. So when the company has revalued their land or revalued their plant and machinery to the fair market value, you need what? You need experts' help. You need a valuer's help to see whether the value which the company has adopted, whether that is correct or not. Whether the value that the company has adopted, whether that value is correct or not, for checking that, you need the help of an expert. You need the help of a valuer. So you will be using the work of an expert in that case. You will be using the work of an expert in that case. So read use of auditors, experts. Auditors, in this case, when you're using the work of an expert, when you're using the work of that valuer, it's not the case that you can delegate your responsibility to him. The responsibility finally lies upon you. The responsibility to check whether the financial statements contain material misstatements or not. the responsibility to check whether the financial statements contain material misstatements or not, that responsibility is lying upon you. It is not the case that you can pass on that responsibility to someone else, right? That is not the case. That is not the case here. The responsibility lies upon you. You're only taking his help. You're only taking his advice, right? So auditor cannot delegate the responsibility completely to the experts. See the examples of experts: surveyors, the land surveyors, as to what, what piece of land, what is the area of the land that belongs to the company. Who decides that? The surveyors are the experts in that. The surveyors can tell us what is the area of the land that is belonging to the company. So surveyors, valuers, expert inventory counters, right? Actuaries. Actuaries is for what? Actuaries is for insurance, right? So all of these are what? All of these are experts whose services you can use while you're doing your audit. Okay. Next, the auditor is still responsible for obtaining sufficient and appropriate audit evidence. And that expert should be how? He should be independent. He should be objective. He should be competent and experienced. I hope you know all of these words by now. We know what is independence. We know what is objective. We know what is competent and experienced. Next, what should you do before the work is performed by the expert? What all things should you basically agree with the expert before he starts your work? What should you agree? You should agree the nature, the scope, and the objective of the work. What is going to be the scope of the work that expert is doing? What is going to be the nature of that work? What is going to be the objective of that work? So nature, scope, and objective, agree that with the expert. Agree the nature, scope, and objectives. Next, agree the roles and responsibilities. Then agree the roles and responsibilities. What is going to be his responsibility? What is going to be his role? What is going to be your role? Agree that. Next, agree nature, timing, and extent of communication. How are you going to communicate with that person? How are you going to communicate with that expert? Agree that. What is going to be the mode of communication? And lastly, agree the need for expert to observe confidentiality. Agree that the expert also needs to remain confidential about the information that he gets while he's doing his work. Confidentiality is to be maintained because the expert will also get to know information about the client, right? And you and the expert both have to remain confidential about it. It should not be the case that the information is being leaked to outsiders. So agree that also. And last, how do you evaluate the work of the expert? What do? You check whether the conclusions or the findings of the expert, the conclusion that he's giving in his report, whether that conclusion is relevant and reasonable. The conclusion that he has gotten to, whether that conclusion, whether that findings, whether his conclusion in his expert's report, whether that findings or conclusion is relevant and reasonable. So relevance and reasonableness of findings. Next, relevance and reasonableness of assumptions. You will check whether the assumptions that he has taken, because in order to get to a conclusion, the experts might have taken a lot of assumptions, right? So see whether those assumptions are relevant and reasonable. And lastly, the source data that the expert has used, the data or the financial data or the source data that the expert has used, whether that source data is relevant, complete, and accurate. The source data which the expert has used, whether that source data was relevant, whether it was complete, and whether it was accurate. Check that also. So that's how you evaluate the work of an expert. You check the work of an expert. Great. So this is relying on the work of others. First part, experts. Let's go to the second part, internal audit. We will discuss this part and then we can end the class. We will discuss this part and then we can end the class. Now, let's say you are the external auditor. The company that you're auditing, let's say that company already has an internal auditor. You are the external auditor. The company that you're auditing, that company already has an internal auditor. Now, that internal auditor of that company might have done a lot of work already, right? That internal auditor of that company might have done a lot of work already. He must have seen the processes and procedures of the company. He must have tested the internal controls of the company. He must have seen whether the internal controls are operating effectively or not. All of that is the job of an internal auditor, right? To check the internal processes of the company, the procedures of the company, whether the processes and procedures of the company, whether they have proper internal controls, whether the controls are operating effectively or not. All of that you will check. Correct? All of that internal auditor is checking. You as an external auditor, you also need that kind of information, right? Rather than you testing the internal controls, you also need to test internal controls for determining the control risk involved. I hope you remember. You also need to test the internal controls in order to determine whether internal controls are operating effectively or not, because that will determine the control risk. So rather than you testing the internal controls, you can rely upon the work of the internal auditor. You can rely upon the internal auditor's work. You can take the help of him. So read, the external auditor may wish to rely on the work of internal audit in order to reduce the amount of detailed testing, right? In order to reduce their testing, they can rely on the work of the internal auditor. Next, assessing the internal audit function. Before any reliance is made, assess the internal audit function. Don't just blindly rely upon them. Don't just blindly rely upon them. Assess the internal audit function. What do you do in the assessment? You see what is their organizational status, what is the scope of their function, what is their technical competence, are they competent enough, have they followed due professional care, were they professional when carrying out their work. So check all of those things before relying upon their work. Next, assessing the internal audit work. How do you assess whether their work is correct or not? What do? You should see whether they have obtained sufficient and appropriate evidence while doing the internal audit work. While doing the internal audit work, did they obtain sufficient and appropriate audit evidence? Are their conclusions valid? Did they obtain sufficient and appropriate evidence? Are the conclusions that they are making, are their conclusions valid? Whether their work has been properly supervised and reviewed, whether they've included the direction, supervision, and review in their procedures when they were doing internal audit, supervision and review. See whether that has happened or not. Because then only you can rely upon their work, right? Otherwise, blindly you cannot. Okay. This was about using the internal auditor's work. Next topic is about using them for assistance. Can you take their help to assist you? For example, let's say you want to check the rent expenditure in the P&L. Can you tell the internal auditor? Can you take the help of internal auditor in order to check the rent expenditure which is being shown in the P&L? Can you tell the internal auditor to perform substantive procedures to check whether the rent expenditure which is being shown in P&L is appropriate or not? Now, you can take the help of internal auditors, but there are laws and regulations which apply here. For example, in a lot of countries, in case of listed companies, you cannot take the direct assistance of internal auditor. In case of what? In case of listed companies. If your client is a listed company, if your client is a public entity, then you cannot take the help of an internal auditor for your job. Basically, you cannot delegate him your job. You cannot give him your job to do if your client is a listed entity or a public entity. Also, if the area has a high risk of material misstatement, if that specific area has a higher risk of material misstatement, again, you cannot give that area's work to internal auditor. If that area has a high risk of material misstatement or it involves a lot of judgment, that area you cannot give it to the internal auditor. That area you have to do it on your own. You cannot give that to internal auditor. And before giving any work to the internal auditor, what should you see? You should see their competency. How competent are they? You should see their competency as to how competent are they. Are they competent enough? Do they have the necessary skills and experience to do that work? So see that also. All right. So read. Internal audit function can provide direct assistance to the external auditor under their supervision and review. So external auditor will supervise and review the work that internal auditor will do. Next, it cannot be provided where laws and regulations prohibit it. Like I gave you an example that some countries prohibit listed companies from doing this. So if you are the external auditor of listed company, you cannot take the help of an internal auditor. You cannot, use the internal auditor for direct assistance. Next, the competency and the objectivity of the internal auditor must be considered. You should consider how competent are they. You should consider their objectivity. Next, you must not do work which involves significant judgment, a high risk of material misstatement, or with which the internal auditor himself has been involved. The planned work must be communicated with those charged with governance. You should communicate this plan to TCWG, to audit committee plus board of directors. They should be informed that you are taking the assistance of internal auditor. So communicate with them your plan to TCWG. You cannot excessively use internal auditor, of course. And lastly, management must not intervene in that work. In the work that internal auditor is doing, the management should not intervene, should not interfere, basically. So that is about using the internal auditor to provide you direct assistance. All right. Okay. So we don't have much time to continue our discussion to the next topic. A last topic is left in this particular chapter, which is service organizations. So this we will continue in our next class, which is tomorrow, right? Tomorrow is Friday. Yes. In tomorrow's class, we will, of course, complete that small topic and also start our next chapter, which is systems and controls, which is about internal controls. So we will start that chapter. Internal controls chapter is an easier chapter from the perspective of the chapter, but the questions can be a little tricky. So we'll be seeing questions also from the exam kit, because from that chapter, the questions can be a little tricky. All right. So I will end the class here. Do you have any doubts before that? If somebody has any doubts, you can put that out in the chat box. If you have doubts, please put that in the chat box. Or you can unmute yourself. I have given you that option of unmuting yourself now. If you have any doubts, you can also unmute yourself and ask the doubt. No doubts? Okay. So we'll end the class here and I will see you tomorrow at the same time, of course, 9 o'clock, and we will continue our discussion. And I hope you have a good day ahead, and please keep studying, keep revising whatever we've studied, and I will see you tomorrow. So thank you. Thanks a lot for joining. Bye-bye. Have a good day ahead.